Hey folks, welcome back. This is Peter Lehrman from Masters in Small Business M&A. Really excited to have two founding partners of LP First Capital join today, Thomas Ince, Logan Lowry. Great to have you guys on the podcast. We're a couple weeks out from the flurry of McGuire Woods and the Dallas conference. So it's a great time to connect with you all. I appreciate you guys making time and getting on the recording studio with me here.
Yeah, thanks, Peter. Thanks for having us.
Yeah,
Thank
you
you.
bet.
Looking forward to it.
Are you guys both in Austin right now?
Yep. Yeah, we're all in Austin pretty much.
Whole team?
One guy's in Denver. Some of our BD teams across the country, but everyone here is here in Austin.
I want to just get started. Just asking you how you decided to name the firm LP First. It's a 7-year-old name. Love to just get into the origin story a little bit by just having you explain how you chose the name. What does the name of the firm mean? What does it come to mean now that you guys are 7 years in? Maybe it's taken on more meaning now than it did when you first had it. So I'd love to just start the sort of origin story question and conversation there. And then we'll get into the business and the businesses and the team and all the things that you guys have done in the last 7 years.
Yeah. I'll take that. I think we can hop in too. In 2018, when we started up, at the time I was growing a holding company. It had about 4 different businesses in it. And so I was really more of an entrepreneur, becoming an independent sponsor. And so when I first went out under the independent sponsor model underneath that holding company name and try to raise underneath that. And it just didn't seem like it resonated with the investor community at that time. And so I thought I needed to create a separate brand as an independent sponsor because I really had this holding company. And I was just thinking about the brand. I guess a couple of themes with LP First was one, I think if you always provide value to people and serve others, you usually get value back in return. So there's a theme of that with this year that we're here to provide value to investors and not just think about getting rich off of fees. And that was sort of my perception at the time. And at the time also, I thought I wasn't in this world. So I thought I'm going to be happy with structure that's very, very similar to like you see in any waterfall structure, most independent sponsored deals at the time. But my perception at the time was everything was 2 and 20 in the independent sponsor world. So part of the name LP First came from that angle, like trying to set up structures to where there's very little carry and fees till you achieve a 2x or something like that. And another theme of the name was investing in founder-only businesses, so providing investors access to that in the market. And maybe the fourth theme was whenever you're a searcher and independent sponsor and you're starting out, like you don't really have much of a track record, and you have to sometimes fake it till you make it. And there's an element of indicating that you have money when you're still forming those connections. And I think we've been able to do that over time now that we've closed almost 70 deals. But at first, in the first deal, it helps out having sort of being able to explain to a founder what LP means. So there's an element of that too. But hopefully that answers that question.
Yeah, for sure. Yeah, no, for sure. You guys feel like the incentive structure has been fundamentally different from day one, and in terms of the way you thought about structuring the transactions and structuring incentives? Sounds like that's an important one of the answers.
Yeah, with our investors and management teams, I would say we're going to be largely very similar to a lot of other independent sponsors, and how things are structured in terms of waterfall you'll typically see. So I would say that we're closer to market there versus something on the one end of the spectrum or other. Would you agree with that, Logan, or anything outside of that?
Yeah, and I think what's interesting, you mentioned, Peter, that the name might have taken on different meanings as the firm has progressed. I think that's very much true. One thing that we probably didn't appreciate in the early days of LP First Capital was how many different types of LPs we would eventually come to have here. So as an independent sponsor, if you're in that space, you'll know this, but some of our investors are other committed private equity funds in a certain investment for us. In other instances, we're working with institutional LPs, we're working with family offices, we're working with individuals, we're certainly working with founders and sellers who are reinvesting back alongside of us. And so the mix of LPs that are in our investments is quite large, and it varies by company. And so I think that we try to think about that mix of LPs in every, or first, to use the cliche naming, in every instance, in the instance of like how we capitalize our deals on the front end, making sure that we have the right type of LPs in a specific investment for our objectives. That's not always the case in the independent sponsor community. Oftentimes independent sponsors are pressed for capital, they're on tight timelines, and it's the first capital that you get a term sheet from wins the deal for you. But we've found over time that there's misalignment there. So just thinking through how do we capitalize our deals, and then once we're in the investments, making sure that we understand what the objectives of our LPs actually are for the investment. Of course, everyone wants to generate a high return and return as much capital, but there's nuances, right? There's timelines to consider, there's capital deployment requirements. And so, thinking through all of that and thinking through your LPs and what their objectives are and putting them first to use the naming convention, I think it's just a general mindset that hopefully leads to better outcomes for everyone, us as the sponsor, them as the LPs, and then obviously the management team and everyone involved. So we probably didn't appreciate how important that would be when the name was first made, but it's something that took time and experience and some bumps in the road of misaligning capital with objectives to sort of come around to that being a core part of what we're trying to do here at the firm.
Yeah, that's great, Logan. I think that is kind of what I was getting at. I mean, would you be up for maybe talking a little bit about how different deals call for different potential LP mixes? And do you guys have any general, not like, overly boilerplate, but do you have any general frameworks or just templates for sort of like, well, if we're doing a transaction like this, we're buying a business like this, we're probably going to solve for an LP composition like this, whereas a different kind of transaction, it's either longer duration or is, got a different capital structure, day one, unlevered versus levered. Like, I'd love to just hear how you guys have thought about the LP mix on a deal by deal basis, and the extent to which you sort of have come up with rules of thumb for how you think about different LP compositions for different kinds of businesses that you guys are excited to buy.
Yep. Logan, you want to take that and I hop in?
Sure. I think the most simple answer, Peter, starts with what is the amount of capital that you're trying to deploy. Obviously, for example, on some of our investments, we're trying to deploy $50 to $100 million of equity capital, which is for us is a good sweet spot for our size firm. You obviously can't deploy that much capital if you're raising it in $250 to $1 million chunks. You need to go get larger institutional LPs who can write bigger checks. So I think it starts there. And then the second thing is I think it's really important to align with investors who have experience in the type of investment thesis that you're going after. So a clear example for us is we do a lot of buy and build investment strategies where the portfolio companies are highly acquisitive. We want to make sure that the investment partners that we're partnering up with have done that before, not only because of the speed of deployment of the capital and how it can sometimes be sporadic. We might have a lot of acquisitions in one year and slower in the next, right? We want them to be comfortable with that. We want them to be comfortable with some of the integration and the timelines it takes to roll in a number of different acquisitions, right? In full transparency, sometimes when you're doing that, you'll see a little bit of a trough of EBITDA, right? And some of that's by design. You're building teams, you're adding new infrastructure. It's all intended to be for growth in the long term. If you're partnered up with an investment or an investor, an LP who hasn't done that before, I think intuitively people understand that might be a part of the strategy. But when you get in that trough, if you've never been there before, you don't want to be going through that your first time together, right? As an independent sponsor where there's a significant amount of the capital coming from a different group. So I think that's important. Thomas, would you add anything there?
Yeah, I think if you model it out, a lot of times it makes sense to bring on debt early on and start off nicely levered. But we've found over time, it's when you're doing a buy and build, it's nice to start off. We've closed a number of deals all equity, and as time goes on, we lever up as we go, and that helps out a lot in the independent sponsor model. in our opinion, because if there is a trough, you have the ability to add debt and then acquire your way through it. Let's just say if you bought a business for 3 million of EBITDA and you hired a million in corporate overhead and a new management team, and you grew the underlying business, 500K, over 10% in the first year. Everyone's going to look at it. It's went down. Everyone's like, what happened? It's hard to explain that narrative. I mean, you can segment it out, and it's hard to go out and raise deal by deal. I think it's a lot harder to raise $3 million than it is to raise 30. And if you start off over equitized, all that additional free cash flow can be redeployed into and allocated to parts of the business that have the greatest growth initiatives. And you start off with a good organic growth story, and then you lever up as you go. I don't know if we would do that if we had a fund always, but we actually probably would. I mean, we like that model a lot. We like bringing on debt closer to 10 million of EBITDA than 3 or 5. A lot of our deals, we want to get to that 50 to 100 million deployed, but we might start off with a smaller check because we do a lot of off-market sourcing. We don't participate in auction processes. We are very thesis-oriented, so we pick an idea and work on it, and that often sometimes leads to off-market deals in the 3 million EBITDA range or 2, and not at big process prices. And we found to like close a few of those all equity. The narrative looks a lot better as we raise if we have to bring on additional equity later on. Like, so we just closed on a restoration platform last month and close all equity on that one. We hopefully will close on the second add-on this week. We'll close all equity on that. Then we'll bring on a lender and acquire as we go. And so that's sort of like our typical playbook that we like to deploy. And so having an investor like Logan saying that wants to do it is really important, because we've done some deals in the past where we get it closed, but then a lot of the investors aren't lined up ready to go for the next add-on. And it's scenarios like we described where we built up the team to go do it, and then you spend an extra amount of energy and time trying to get the equity lined up for the next add-on if you levered up initially on and no one's really geared to doing buy and build.
Right. Yeah. What do you guys do? Are you guys calling additional equity for this restoration add-on, or are you just sufficiently equitized from the original transaction? Is that part of how you plan it out?
Yeah, we have basically 2 sleeves of capital. So one part we're calling, and then the other sleeve is more of our anchor investor. We haven't announced it yet, but hopefully by the time this podcast goes out, we have the press release. We'll probably release it next week. But the anchor is Align Collaborate, and they've been a great partner. They're just committed to the strategy, I would say. And so everyone's expected to close the next deal. That's one where we will close on the first 2, and then we're going to bring on a lender and probably, we like to say, like, start off grass fed and then corn finished. We're going to fatten it up as we go. And then, we'll have to eventually bring on additional equity, when it makes sense. But if you have line of sight to 10 million of EBITDA, we found that's a lot easier to get a good DDTL, a good non-bank lender, and that's really excited about doing a buy and build. If you start off in the sub 5 million range, it's sometimes hard to get that lender on board at that time, and spend a lot of time trying to refinance them out later if you get one lender to do a buy and build.
I'd love to. I know you guys are co-GPs, and in some cases you have significant LPs, full-fledged private equity firms who are your partners in the LP stack. And I think it would be really interesting to hear you guys just talk a little bit about how you're partnering with private equity GPs as your LP, just because I think that's the area where there's like the most amount of co-opetition between independent sponsors and private equity funds. We just like released this big survey, this Axial independent sponsor research survey, and there's no question that the family office kind of category is like, I think, the primary category that independent sponsors tend to raise capital out of. But there's a significant amount of capital being raised from private equity funds by the independent sponsor community. And I would love to hear you guys just sort of lay out some of your experiences there. How do you guys do that? How do you get comfortable doing that? How do you guys think about the competitive elements of it, and how do you guys deal with some of the maybe economic issues related to it? I think it's just an interesting area. I haven't heard anybody kind of talk about it on a podcast yet, so I'd love to give it some visibility if you guys are up for that.
Yeah, sure. Yeah, Logan, you want to take that? I don't know. Then
Go for it, Logan.
So we have partnered with at least 4 to 5 different private equity firms off the top of my head. I hope I'm not missing one. And they've all been really great relationships. I think in the independent sponsor community, there is a tendency by independent sponsors to want to shy away from committed private equity funds for a couple of different reasons. One, there's this narrative that the economic structure with GPs is not as good. I would argue that that's not the case. I would say it's at least equal in most cases, assuming the underlying investment opportunity is a good one as well. It's just as good as we get, if not better in some instances, than what we get from a family office or other institutional LP. So I think that's a narrative that we don't really subscribe to. The other tendency why I think some independent sponsors, and this is just my opinion, have shied away from it is I think there's a tendency to want to do everything yourself as an independent sponsor. And there's this perceived notion of you're giving up board control, you're giving up governance control when you partner with a GP. And ultimately, we all know if the GP is putting up the bulk of the capital, they have the right to make the final say on any decision that comes to a head that, maybe there's not group alignment on, right? And there's a tendency to want to avoid that. I think we've sort of thought about it a little bit differently and leaned into that in certain instances and how we've done that is we've partnered with 4 or 5 different firms that we spent a lot of time getting to know before we partnered up with them on probably at least half, if not more than half of the occasions where we partnered with a GP. We might have worked with them for 6 or 12 months prior to our first investment, developing a thesis with them, meeting with them weekly, sharing with them updates around what we're doing, building a buy box, letting them run their own traps on, the thesis and talking within their network, they're sourcing opportunities alongside us. So there starts to be a good relationship here where we know that the GP ultimately has control, but at the same time, there's a mutual respect around what we bring to the table, the value that the independent sponsor's bringing, and we have a seat at the table. I would say in all of our GP relationships, we certainly have seats on the board. I think our voice is as loud and as meaningful and carries as much weight as any other person on the board, and they've just been great relationships for us. So I think that we'll continue to use those relationships in certain instances. Typically, those tend to be instances where we're trying to deploy more capital and we can get it all from one source. We'll kind of lean in, develop a thesis, work with the GP, and then ultimately, hopefully, tie the knot with one.
Yeah. I would say that it's sort of, I would look at it as a partnership, and these are deals that we've often, when we're doing this, we're working on that thesis for a while before we're not coming to them with an individual deal. We're working together, coming up with it together, and so you don't really even go outbound in those instances. We have in some cases where we've negotiated like a 20% sleeve or 10% sleeve that we can raise with relationships that we have, just so we can bring some committed capital to the table outside of that relationship. And one thing that's maybe a little different, there's some deals, like say this restoration deal, we didn't take it to any GPs. Right now, we've had a number of GPs, because we have worked with some where they've reached, some new ones have reached out and like, hey, we want to get into the insurance brokerage space or pests, these hot sectors. And, we've thought about some of those, but, sometimes it's a little bit like there's a element of absolute value versus relative value. And we're more in the absolute value camp often. But, if we can see a path to 5X, 3X, with, playing the relative value game. And, they've been outbid, their minimum's 10 million EBITDA. And they're like, hey, how about, we're not really geared to go out and buy a lot of 2-3 million EBITDA companies. Can we team up and do it with y'all? That's the sort of the camp that we will normally work with the GP on going forward. Because we usually the ones that were, I would say, like our blockbuster type ones, we're taking those to family offices or pools of capital like Align Collaborate, which is sort of like a best of both worlds. And with them, they give you all the board seats, you have all control you want, but there's also additional resources because they're associated with Align Capital. if you need some additional help on, sourcing a CFO, like they might have some relationships that you don't have, which is helpful. So, you have like three main economics too. It's hard to ramble on here, but like you have, the ones that we always know about: closing fees, management fees, carry, but you get paid, and you can also get paid in experience and knowledge. That's something a lot of people don't think about, and you can learn a lot working with other groups, and we've found that collaborative approach being very helpful.
How are you guys deciding who to do this with? Like, Logan, you were mentioning like there's sort of 4 or 5 firms now that you've worked with that are full-fledged private equity firms. How do you end up deciding to work with them on different, and it sounds like you get to know one another for a while. Like, yeah, I'm just kind of curious, like how that process unfolds, how you decide to move ahead. Are there elements of trust that are part of the equation? Just how does it get out of the blocks? How do you decide to spend your time and your people's time working with them? And I'd love to just sort of hear how you guys leg into the partnerships with a given private equity firm on a given thesis.
From my perspective, the first thing that we're trying to figure out is, have they worked with an independent sponsor before? There are certain GPs, in my opinion, that have very established track records of working collaboratively with an independent sponsor. There's another wave of GPs that have entered into the market in the last couple of years as the independent sponsor community is growing. You mentioned McGuire Woods; that conference is exploding. It's brought a lot of new GPs to the space that want to work with independent sponsors, but I'm not quite sure they fully appreciate the value that an independent sponsor can bring. They more look at independent sponsors as just a deal sourcing funnel for them, that really, we're going to bring a deal and then you guys are going to run with it. And so the first thing I'm always trying to figure out is, what types of decisions do you guys want to make versus what type of decisions do you want us to be making day to day, hour to hour in an investment? What's sort of the cadence of how we're going to operate, in terms like asking very detailed questions around, okay, if we source an opportunity, what is your process for submitting an LOI? Do we have to go to multiple iterations of your committee, or do you, whoever the lead partner that we're working with, do you have the discretion to make certain decisions? What decisions do you want us to make? And so it's getting a little bit more in the weeds. I mean, certainly economics are important, but I would say that's one of the least important factors of what we're trying to do. What are their processes and procedures? How have they worked with independent sponsors in the past? What have been the outcomes of those independent sponsor partnerships? Not necessarily what was the economic return, but more so, was the independent sponsor involved in the entire process? How much of the work did the independent sponsor do versus how much did you guys do? And why was that? Whatever the answer is. And every independent sponsor brings something different to the table. So it's not always an apples to apples comparison, but you start to peel back the onion, you can figure out really quickly whether you're working with a partner that wants to lean in and use the independent sponsor as a way to accelerate returns and maximize returns versus just deploy more capital because they're a deal sourcing funnel. So that's important.
Do you guys feel like there's something specific about your posture and your position that makes you particularly advantaged at LP first to do certain things and makes private equity funds? Is there a natural complementarity to the partnership that you seek, or is it really case by case? Does there tend to be like a typical role that you guys are seeking to play and that you're looking for your private equity fund sort of GP partners to play, or does it really vary from one transaction to the next in your experience so far?
I would say we have tried to develop and build our firm to where we look more like a lower middle market traditional private equity fund, where we have skill set to do anything and everything within an investment. And I think we're proving out that that's possible, and that we have half of our, if not more than half now of our investments, we're not partnered with a GP. And so one thing that we really look for is a GP who certainly is collaborative. We want to use all of their resources. We want to work hand in hand with them. We're not trying to claim that we're the smartest people in the rooms by any means, to Thomas's point around them bringing education experience to the partnership. One thing that I think we look for, Thomas, I'm curious to get your thoughts as well, is just how much room are we going to be able to run? Or is every decision are we going to have a GP sitting over our shoulder questioning every decision, or are we going to be able to build a level of trust where you let LP first go out and do what we do, which is feel like we're very good at sourcing, we're very good at working with management teams and bringing those teams to the table, and then also working with our management teams on integration on the backside of the investment. One thing I'm always looking for is, are you going to let us do what we think is our value proposition and our skill set? Because if not, then it's not going to be a good partnership. We're going to be wanting to do more, and you guys are going to want to be holding us off. There's no right or wrong answer to any approach that a GP takes, but making sure that you have that alignment is really key. And I think that we probably, compared to most independent sponsors, have a broader skill set just because we bring a bigger team to the table. Not that our skill set's better than any other independent sponsors, just we're staffing 3, 4, 5-person deal teams to all of our investments. We can do a lot. I've talked with other independent sponsors who are, maybe they're great. They're great operators. They have great operational experience and backgrounds, but they don't really have sourcing and M&A capabilities. And so I've encouraged them, like, hey, really partner with a firm that wants to lean in and help you on that aspect of the chain of the investment. And so it's certainly case by case.
Yeah, we're talking a lot about our GP relationships here, and that's like Logan's point. It's there's really, I guess we have 4 deals right now with I think, and I think our mindset is we work really well with others. I guess we're very collaborative. So we've developed a lot of trust with our GPs, and we've been very blessed with the firms that we've worked with. We move with great speed and urgency, and have a lot of systems around sourcing, and also have a detailed operating playbook that we like to deploy and how to integrate the businesses that we acquire, and have a lot of unique skill sets amongst our team and with operating backgrounds. And that seems to be very valued with our partners. And there hasn't ever been a big disagreement with any of our partners. And it's been I can see how with some groups it could go wrong. We've been very selective, and we had other options to close these deals outside of the GPs, but we thought, hey, they wanted to deploy 100 million. We like that. They like the thesis. We like it. And acquisitive buy and build models, it's a good fit. The PE model lends itself to get more bureaucratic as you get big. When you have a $5 billion fund or something like that, we can move and act on opportunities faster outside of that system, but be connected to it. It's been complementary, I think, to the model, and we're finding opportunities, diligencing them, creating the deal memo, getting final sign off on it from them in those cases, but sort of moving outside of that, their current systems, which I think has led to a lot of velocity, having this paired up with some groups that we've worked with.
Can you talk a little bit about the speed and the urgency that you just mentioned? That sounds interesting, and that sounds deliberate. Sounds like something that has been a priority for you, Thomas, and for you, Logan. What are you talking about when you talk about speed and urgency, and why have you prioritized it, and how have you created it?
It's actually one of even our core values, speed. We always try to answer our emails every day and respond. And if you look at, say, 100 deals, occasionally you'll find one that really gets your hair standing up on your arms and you get excited about. And in those instances, I think we're pretty quick to get on a call with the advisor or the owner and get on a plane and go out and meet with them. That's proven helpful too. I think winning a lot of deals. I mean, we're not always winning deals because of speed, but if you're acting interested and moving quick, people value that.
Why doesn't everybody do it then?
Well, it's really hard. Everyone's busy. It's hard to put the kids down to bed and answer emails to 12:30 at night. And wake up the next day and do it, and also prioritize activity. Like, there's a formula I talked about for a podcast that I don't want to, but it's called it's A times E equals R, like activity times effectiveness equals results. And so we try to produce a lot of activities and also think about the method of how effective those activities are. And that ultimately provides results. So, like, during this call here, this podcast, we should have 60, about 30 outbound calls that happen with some BD guys that have a list that was prepared the day before. And if you're deliberate, like, let's say, like in the restoration space, we have a list of our Billboard 100 that we or we want to, that we would be honored to partner with. And that takes time and effort to generate that list. And there's other targets outside of that. But if you know who the owners are, cell phones, emails, reach out in deliberate fashions, you can source good deals like that. And sourcing creates a lot of value, in our opinion.
We also have we tend to be very thematic and are only working on 1 to 2 investment theses at a time. And in those, we'll have very definitive buy boxes of what we like and what we don't like. And so when we see an opportunity that pops up, pretty quickly we can figure out whether or not it's a good fit for what we're trying to do. We're not chasing 10 or 15 different things at one time. We're chasing 1 or 2. That helps you to move with speed. The other thing I would say that we try to prioritize is making sure that we're understanding our audience on the other side of the transaction, meaning the seller and the seller's broker, if they have one. At least for us, every independent sponsor works on different size transactions. And as you move up market, you get more sophistication, generally speaking. But we're playing in the lower middle market. Most of the companies we're buying are 1 to 3 million of EBITDA. You have to make sure you speak the language of the seller. You have to make sure you curate your information requests towards a way that they can receive it and respond to it well. You can't send over 50 item diligence request lists on your first meeting. 90% of their decision is going to be around who the person is that they're dealing with. Of course, terms are important, but just being able to develop a relationship with them quickly. And so one thing I always tell our guys is, can we get to the right decision with only 70 to 80% of the information? I think that's one thing we try to do well, is get most of what we need. And does it get us to a go or no go decision? The other 20% of the information is important. We'll find it out at some point in our diligence process, but do we really need it now, or can we wait a month from now? And that's very hard to do, because obviously you're not trying to be reckless or miss diligence items. That's no one's intent, right? But that's how you can move with speed. And I think a lot of our competitors get too bogged down in trying to know everything about a company, and you can just wear a seller out and they will have deal fatigue with you right out of the gates. And I think that's where we try to just connect with sellers faster, get to the go or no go decision really quick. As simple as it sounds, it's actually a lost art, in our opinion, in this space.
That makes sense. That restoration platform that we closed on last month, we started working on that like last March, 18 months ago or so. Yeah. And it took a while to develop it. We talked to our ideas around the space changed over time. We talked to a lot of bankers, former sellers, and we just worked on it a good bit, and we were going to do it. Like, it doesn't matter if we were looking at one company and that passed, like, we're going to eventually get that done. We've done that before and walked away from the space, but as long as we like the sector, we're going to keep after it. We're in Austin right now. If we drove across Austin and the other end, you probably wouldn't notice a purple truck driving, a purple car. But if you were looking for them, you probably would see them. So you tend to find opportunities there, and that it sort of compounds over time. You talk to people, they always open other doors for you. You talk to a consultant, they might connect you with the owner or maybe another consultant, and you just keep on acting interested and curious about the space, because you are, and each conversation leads to another conversation and another door, and eventually you find your platform. And you might talk to someone that's been hit up by PE firms 5 times a week for the last year, but I think that dedication and dream and enthusiasm and knowledge about the sector comes through when you meet them, and it helps you win competitive deals.
I was going to ask you guys, could you get into the buy box that you guys draw? Could you talk about a buy box, explain what an LP first buy box has in it? I understand the term. I think the term is well understood conceptually by the trade, but what defines the LP first buy box, and how does the LP first buy box try and lean into some of these elements that you just mentioned, Logan, like, getting to a yes, no with only 60% of the information? I'd love to hear some specifics to the extent you guys are good to share it.
Do you want to start there?
Yeah. I mean, I think it's different when you are looking at a platform versus an add-on. I would say
you can pick a platform and, dive in on a platform.
Yeah. So a platform, we don't always have to have a founder. We've done some without a founder staying on or a management team, but we really love it. Like we get a lot of excitement. I think part of it's if we keep on looking in the space and we find someone with a, like I like to say, like a sparkle in their eye that really lights up at the idea of building a $300 million revenue platform. There might be a 30 and they just get really excited about rolling over a ton, growing something. They've been in the sector for 20 years and there's still a lot of gas in their tank. We love that. And we love it, when the management teams are like that too. It's aside from, I think, making a good investment case doing that, it's just sort of fun, like finding someone with a dream and that you help achieve their dream. That individual may not always be the CEO long term. They might know their limitation. They might be the CEO. We've done that. But we are often looking for like our platform guy. It's not or is our platform team. It's not just a business. It's something like that. We might have ideas on the right service mix of the business. We're in the trades a lot. You don't want to have a high percentage of construction revenue, stuff like that. But and then for the add-ons, it's gonna be. I mean, you could probably talk about that, on some of the add-ons with service mixes and size characteristics. Maybe talk about that, how we have a buy box, a deal memo for every deal.
I think all the typical characteristics and KPIs that you would expect and that most of your listeners are familiar with, Peter, are in the buy box, right? It's revenue size, it's EBITDA size, it's geography, service mix that's applicable to the industry, all of those basic things. To Thomas's point, I think you can be more flexible on that in an add-on scenario where you've got an existing management team in the region so that the owner operator is not as important, or maybe there's synergies there that you can think about. Outside of the basics, but I would go back to what Thomas says. It almost always comes back to the individual on the buy box. Maybe that's a little bit different about our firm versus other firms that are larger than us is we're oftentimes looking for platforms that are just below in size what most traditional private equity firms in the lower middle market are looking for. So they have very rigid, hey, we don't go below 4 million of EBITDA as a platform. Well, that's great. We know that. I've heard that 100 times. I want to get in the high threes then, because there's oftentimes really successful owner operators who just haven't quite met the criteria, but with a little bit of assistance and help can become a rising star. That's where I think we play really well. And again, it all comes back to the person. We could find a perfect fit business with really stable cash flows that is in the industry we want with all the characteristics. But if the individual running the business is not someone that we can get excited about working with, then more times than not, that's not really a good fit for our buy box. And that's hard to put on a sheet of paper and define it. It's more twinkle in their eye that you're looking for, how they talk about their dreams and aspirations, what's their background, what life experiences have they gone through to get them to where they are today, all those type things. Who are their friends? What are their hobbies? What books they read, what podcasts they listen to, all that kind of subjective stuff is what the types of questions that we're going to be asking to see if they fit our buy box.
And do you think that varies meaningfully from the way that, do you think that that's a point of variance between you and other buy boxes to really be very focused on finding like a super energized founder or founder for the platform? To me, it seems like that is, there's no question that the search community doesn't really look for that because they are the,
Yeah.
that's their plan. That's their plan. But it seems to me that a lot of private equity is not excited about buying a business where they feel like they're going to have to turn over the sort of key operator near term. And they're looking for a similar sort of profile to you guys there. That maybe not the way you guys characterize it, but my sense is that private equity doesn't like to turn over the CEO post-transaction unless they have to.
I think that's a general rule of thumb, absolutely. And I would say you're right that every private equity firm, if they write down what they want to do, absolutely, they'd say the operating leader, the seller that's going to work with post close is a very, very important part. That's table stakes. And not to suggest that we can evaluate executive or those sellers any better than anyone else can. I think it's just making sure that that person fits our buy box and how we like to work, right? Everyone can perceive value in that individual differently. To use a simple, almost elementary example, some people want college degrees and Harvard MBAs, and this needs to be your second iteration. You need to have already sold a business, all those type of things. And there's not a right or wrong way for anyone to look at it. There's probably case studies all across the board of success with different profiles of individuals. I think it's more aligning with how Thomas thinks, how I think, how our team thinks, how the speed and urgency that we like to move with. Does that match well with the founders' day-to-day just cadence of how they respond to emails and when they work and how excited they are about an investment opportunity? Making sure it's a good cultural fit. Just regions of the country, people think differently. They have different hobbies. So we're going to end up spending tons of time with this individual. We want to make sure it's an individual that we connect well with and that has that twinkle that we view as perceived value. It's very hard to quantify. And quite frankly, going back to our GP relationships or even all of our investor relationships, there's been owner operators that, we've been right and we've been wrong in certain instances. But in many cases, we've liked an operator and said, this person's we think it's going to be a great fit for the business. And if you go take that same individual to another private equity firm, we've been point blank told some of our most successful businesses are run by CEOs that other investors have said, like, this is the worst CEO that I've ever heard, I've listened to. And it's like, well, he's growing the business every single quarter and he's turned it around and he executes on every initiative. We see it. So it's finding the diamonds in the rough. That's what's the hard part about this industry. That's where it gets competitive.
It's different for a buy and grow model versus like buy and build. Buy and build, it's very entrepreneurial when you're buying multiple 2-3 million EBITDA companies and consolidating and growing to get to 15, 30 million of EBITDA. As you're doing that, you have to be able to create relationships along the way and create systems and be very hands-on often. And you're sort of starting off with not a lot of resources as you're building the team at the FSO, as we call it, field service operation. We've had some CEOs that have had some great successes in the past, but they sort of came in at higher levels. And in some ways, it's a little bit more entrepreneurial, starting off how we start off, 5 million of EBITDA. And not every CEO that's run a 3 million EBITDA business, that skill set translates down to that level. There's a saying, I think from the 3G guys, 3G Capital, but like PSD, like poor, smart, and desire to be rich. A lot of times, like people, they start off and they have a level of urgency and young, hungry energy to do it, and they experience a lot. But then when you build a bigger organization, that it's hard to rekindle that flame and come down into the lower middle mark. We have acquired some platforms worth of 7 million, but oftentimes we're starting off sub 5. It requires a lot of energy and effort to build a platform, because we're really building assets versus buying assets. We're builders at heart, and so you have to have something that sort of matches that level of intensity. So we're oftentimes the founder is not that person that's going to eventually take it to the promised land, but they're on the bus in a key seat with, and we're supplementing around that. That's how we typically do that. And we don't want to force that upon founder, because it's a lot of work, but we have some successes with people doing that.
Could you guys talk maybe a little bit about how you think about holding on to the businesses that you've bought versus exiting those businesses? What's your general point of view on long-term compounding of businesses that you've worked hard to buy and build up? And there are arguments lots of arguments around just the power of that, power of long duration. There's a lot of value in delivering liquidity to investors, right? There's a lot of value in that. There's a lot of predictability and trust that comes from that, and that you build up over time with investors by being a source of liquidity and being able to return capital to them relatively expediently. How have you guys navigated that spectrum of considerations, and what are your thoughts on it? What have you learned? What's changed as you've confronted those decisions across the portfolio?
Let me hop in here too, but I would say starting off, I was a big long-term holdco compounding guy, and I'm still deep down that's who I am now. But going outbound to raise for deals is very hard to pitch them on an evergreen structure, and I don't know how people do it. I don't know how it gets done. I think we could probably get that alpha too, but I think there's a lot of potential exits, creates lots of excitement, among our team too. We have a young team with growing families, and it's if you have an exit in 3 or 5 years, it can change your family tree, and I get a lot of excitement thinking about how my partners can and have good outcomes in the management teams underneath. So I think right now we're in a season of like I would say I started off in the pendulum being far out, and I was like, hey, we're going to be doing long-term holdco compounding, never going to sell. And I think I was doing that, at least that mindset. I was, before that sort of became trendy, because I was sort of coming into that 2017, 18. Now I'm more in the pendulum, like we're going to be if there's a sign on the door, we're building platforms for middle market PE funds that are integrated, growing, great management teams, inquisitive industries it's like a platform of choice for the middle market PE funds out there. And we're going to have a shelf of platforms, and we're going to get top dollar for them. And they're going to be the best platforms people can buy. That's what we're doing right now. I think long term, I think the pendulum will move back over time. Once a lot of the guys have exits, and I've had this before this, as more of the partners here in the firm have exits, I do see it one day sort of picking some ideas and running hard at them for decades. The Brad Pickup model, and we look up to him a lot, and like the 3G guys, at least what they've done, doing things for multi decades and dreaming big and making a dent in the universe and get your mark. But I don't know, Logan, what's your thoughts on all this?
Obviously, who your investors are, you've got to take that into consideration, and what their liquidity timelines are. But I think Thomas has a really good point of, like, people oftentimes ask us, like, how have you all been able to build a big team? And a lot of it is based around how generous we try to be with the economics that an independent sponsor does have. That being an independent sponsor is very, very difficult in our opinion. There's no guaranteed salaries, and so you got these guys starting firms, and that's very difficult to do for most people. And so I think there's this tendency. I will say, as our businesses have gotten older and more mature, they compound. It's easier. It's fat. We probably spend less time on those investments, and they're growing and achieving our objectives faster and faster. And so it can be very difficult to let go of them, because you're thinking, hey, look, if we just hold this another 6 or 12 months, we can see a runway where it could be even a better outcome. But we're trying to build a firm here as well. And so there's nothing wrong, at least in our opinion, with taking some chips off the table from time to time, putting some liquidity in the team's pockets to keep the engine going and to build the firm for the long term, is how we're sort of thinking about it. But certainly that can be difficult in the moment to let something go that you think that there's a little bit more runway with. And we're still, in total transparency, Peter, trying to figure this out ourselves. We're only, I guess, a little over 5 years into being in our first investment. So we're just now getting into the window where we might start seeing more exits. And so maybe ask us a year or two from now, we might have a different thought on that, because we certainly don't know it all at this point, trying to figure it out as we go here.
There's certain deals where there's one right now where the management team a great relationship with them, and they want to keep on going. And they're really, I would say, there's some hesitation of us leaving the equation and our GP partner in that deal, and they want to keep on going. And we have a lot of momentum. We have 8 million of EBITDA under LOI right now. We're thinking about maybe doing CV there, but I think we got an exit would be a great outcome. But it seems like everyone around the table wants to keep on going, and so let's not that part. Let's keep on going, and that has potential to be a very large company one day. But I think investors really prefer liquidity in this market. Every conference I go to, that's a common panel topic, and
yeah, that's their preference until until the weather changes, right? Until the seasons change. I mean, I think there was a lot of capital deployed at pretty high multiples, and I think that a lot of that hasn't got returned. So I do think that probably is the prevailing narrative right now. But you guys seem like you've been navigating it with a lot of pragmatism, both for them and for you, and building out your team. And I could see how you would start out sort of very starry-eyed about long-term permanent capital over the intervening first 1 to 2 decades of your investment organization's life. You would realize there's a much more pragmatic place that you need to arrive at, where you're distributing capital to your partners, you're distributing capital to LPs. And then if you're able to make it to the other side, right, and you're 15, 20, 25 years in, and everybody has got enough capital to more or less live the life that they want to live, then you start to potentially return to that original kind of approach and take a few really big long-term swings. And that makes a lot of sense to me. That makes a lot of sense to me, the way you answered it, Thomas.
Well, you're building the machine as you go. Like right now, we even in some cases went out to go raise $100 million, then we end up raising $30 million on our thesis. And you have a structure where it's not hard to add additional equity as you go. So you can build a big company there and compound long term. But I mentioned Brad Jacobs. I mean, he raised billions for QXO right now, and he did that off a track record providing exits. And he built a $50 billion company there. Didn't happen overnight. It happened over time. And like now, like the best year we've ever done is 19 deals in a year. We haven't been able to top. When you look at firms like Alpine, Shore, they're in the hundreds per year, and we want to be there one day. We want to be doing, something like that. We want to be able to, that track record of success and returns and investors lined up. Nothing happens overnight. You can say you want to do this, but it's nice to build a track record. And over time, people always overestimate what they can do in a year, but underestimate what you can do in a decade. So I think you just keep going at it. You'll eventually build something of value.
Hey guys, maybe that's a great place to end it. It's been great to meet you guys. It's been great to have a chance to learn more about the story. We've covered a lot, learned a lot more about the organization and about you guys. And I think it's really interesting to get into your return on capital points of view. I think it's really interesting and really helpful to the category to think about the way you guys have partnered with private equity GPs. So I think we've covered some really interesting material that doesn't have a lot of prior visibility. So I think a lot of people will enjoy the listen. So thanks for carving out the time and giving it to me and giving it to the listeners. Look forward to following you guys on your path to pulling toe to toe with someone like Brad Jacobs over the next couple of decades. That sounds like a good goal, Thomas.
Well, there's only going to be one Brad Jacobs. We'll have one version of. We appreciate everything you've done here. It's a great platform, Axial, and appreciate you having us on today.
Yeah, thank you.